The first objective in trading is to protect your capital, while the second is to gradually increase it, using a strategy based on compound interest. As in a football match, you have to know when and how to attack, and when and how to defend. Knowing how to attack allows you to progress and increase your capital, while knowing how to defend allows you to protect your results. They both have the same level of importance. Risk management is primarily based on defense. According to statistics, 90% of people lose money in trading because risk is not managed correctly. Many people treat trading like gambling, and risk all of their capital in the hope of quickly doubling it. Initially, it is advisable to risk between 0.5 and 1% per trade, and then increase, after a minimum of 6 consistent months of profit, to a maximum risk of 2%. Professional traders risk no more than 2% of their capital per trade, and properly manage the size and leverage of their positions. All traders face negative streaks, and it is in these situations where risk management becomes fundamental to implement. If you risk 10% for each trade, it means that with 10 trades you will lose all of your capital. Instead, if you risk 1% per trade, after 10 negative trades, you will still have 90% of the capital available. The stop loss is a vital tool that must be set for each trade. Unexpected economic and political news can move the market against your own analysis, and in many cases your mind will not be ready to accept the closure of the trade. The mind will wait and hope for a reversal, which in 95% of cases will not happen, and the loss will increase accordingly. In a risk management strategy, it is important to protect positions in profit by moving the stop loss to the entry price, or in some cases, even moving the stop loss into profit. A good risk management strategy is based on calculating the probability of your system, calculating the risk-reward ratio, and being disciplined to follow a fixed percentage of risk for each trade. The first important step in becoming an independent trader is to have a broad knowledge of the mechanisms that move the Forex market, and to create a system that best reflects your goals and personality. The second phase that will allow you to learn even more will be thanks to the experience that you will acquire by learning from your mistakes. Mistakes can be technical, but initially they will mainly be related to incorrect risk management, opening positions that are too large for your capital, and treating trading as gambling. This is because many traders start with a minimum capital, and try to gamble in the hope of making it grow fast. The first advice is to train and test your strategy on a demo account, for a minimum of 1 month up to a maximum of 3 months, and be able to be consistently profitable, maintaining proper risk management, even if it is virtual money. Once you manage to be profitable with a certain strategy, you can switch to a real account by opening positions with micro lots. Starting to invest with a real account will make various emotions emerge, that must be controlled and managed, such as fear, greed, hope and anger. 90% of success lies in psychological balance and discipline. A written strategy for risk management is essential to remove negative emotions and temptations, which can be detrimental for new traders. Success in trading means being profitable over a long period of time. The true measure of a trader's success lies in repeatability. 3 fundamental concepts to always keep in mind are: always have a higher reward than risk on each trade. Never lose more than the percentage set for your trade. Use a compound interest strategy to gradually grow your capital. The success of a trader lies in the ability to identify a valid entry and exit strategy. We must always be clear about the percentage that we will risk, and at the same time we must have discipline in respecting it. Emotions are not allowed in this business. Follow your strategy, and always be realistic about your expectations. Trading is a real entrepreneurial activity, where your trading capital becomes your company.